On today's hot sheet, I'm discussing housing inventory, housing starts, and completions for January, Zillow's monthly housing market report. Today is Tuesday, February the 20th, 2024. I am Byron Lazine, and the hot sheet starts now. Welcome to today's hot sheet. After the long weekend off of the hot sheet, we took off Monday because the markets weren't open. If you watched Friday's hot sheet, or if you were just headline reading, I should say, then the hot sheet is not over. We are continuing. It's just over for Fridays. All right. So here we go. Let's jump into, as we do to start every single week, let's jump into the weekly housing inventory data. I am pleased with today's data. I like it. I'm satisfied. This is, to me, good momentum for most markets across the country. There are still some that aren't experiencing this increase in inventory. I'm sitting one right now. I'm in my Connecticut studio. This is a market that doesn't have that, doesn't reflect this inventory that we're seeing across the country. But listen, this isn't a stampede of inventory, but this is a good sign. And so you may be in a market that is experiencing better inventory than at this point last year, or you're sitting in one like I am right now that isn't. Love to know in the comments, as well as where you are tuning in live from. Good morning, Marissa from Dallas. Good morning to all of you guys. All right, let's jump into the update here. So weekly inventory from the housing market tracker, which Logan Modeshami puts together for us each and every single week. If you missed the conversation with Logan, go over to @Knowledge Brokers Podcast. Had him on Friday. It was an unbelievable pod. Great discussion with Logan. Weekly inventory changes. What I'm pleased about right here, from February 9 to Feb 16, we were flat on weekly inventory change at a time of year when you typically will see it do this, what it did last year, go down. Last year, it went down, roughly 7,000 active listings on the market. Active inventory, rather, went down 7,000. Same week last year. This time, this week, this year, stays flat. So we're at 494,000 on the active inventory, where last year at this time, we were at 437 on active inventory. Now, this isn't 2019, what I consider normal, a 2019 year in February, where we sat at this point at 817,000 on the active inventory. We're basically, more than half of that, sitting close to 500,000, but nowhere near it, obviously. But we are better than we were last year. I mean, last year we were on a straight nosedive here at this time of year, and we didn't bottom out until April 14th at 406,000. Okay, that was the bottom there last year. Took, really to the middle towards end of spring market, where here this year we're kind of flattening and kind of hanging around this 500,000 mark. So typically this time of year it goes down, and this is being driven primarily by the new listing data. New listings last week were 49,559. New listing data has been really positive in comparison to last year. If we look at last year, this time it was 42,000 plus. We go down to the chart here. The dark red 2024 is sitting above the normal color red. So this is like a maroon for 2024. We're well above what we're experiencing in 2023. Every data point, every week so far this year, we have come in above new listing data in comparison to last year. 2022, a little bit different. But when we compare year over year, every week has been better. Significant jump here when comparing last week to same time last year. We'll see if that continues. Obviously, 2022 levels for new listings were much greater than 2023. We'd like to get above this pink line and beat 2022. That would come as a welcome sign to the market for affordability and for buyers that are on their search. Now, we're going to look at some Zillow data later. It contradicts this Altos data on price cut percentage. Logan said on the pod on Friday, Knowledge Brokers pod, he said you normally will see about a third of homes experience price cuts, and that's exactly where we're at right now. We're at 30%. Um, and he says here every year, one third of all homes take a price cut before selling. That's a typical year. Zillow's data kind of contradicts that a little bit. I'm going to go with Logan on this one. This is a traditional housing activity that happens every year, he says, on the third. So we're sitting there in line with that. We're actually under that at 30%, and we're under price cuts for last year at 31.3%. Now, when we look into Zillow's data, they're projecting an increase in price cuts moving forward here through this spring market. Not sure how I feel about that. Love to know how you feel about that in the comments. Do you expect an increase in price cuts? I guess if you're in one of those markets that's experiencing more inventory than you did last year, you might agree with that. You might say, yeah, I'm going to have some price cuts that are going to be a welcome sign to my buyers here in this spring market. If you're in a market where you're not getting that inventory, it might be hard to imagine a lot of price cuts. Homes that are well priced and that are close to that average or median in any market are still moving very quickly and are typically in a competitive environment. But price cuts are in line with normal, typical markets. And in fact, they're down less than last year. Let's talk a little bit about the mortgage rate. And we had a lengthy conversation with Logan about this on Knowledge Brokers podcast on Friday. I've been cautioning everybody here to not buy into this 5% hype because you're going to mislead a lot of consumers if you start guaranteeing 5. Logan's prediction is that we could still get into the high fives. He's standing by that. He still believes that that can happen, but it happens with job data that gets weaker. So if you're banking on, hoping for, wanting to experience a faster drop in the 30-year fixed, that will come with job loss. That's the clearest, most fast path to a 30-year fixed coming down into the fives is weaker labor data. Okay, so it's kind of a catch-22. It's like, okay, do I want to root for job loss? Which is kind of hard to imagine when we have 8 million job openings, 8 or 9 million job openings. We have a incredibly strong labor data week over week. It's kind of hard to imagine, but Logan, I'll just go break this down real quick. What he talks about in mortgages this week, and this is a little bit of some of the things he mentions. He goes a lot deeper on Knowledge Brokers Pod. If you haven't checked that out, I encourage you to do so. We are approaching a critical technical level on the 10-year yield that can cause market drama. We don't like drama for mortgage rates. For those who have followed his stories for over a year, the essential level of 4.34 is getting close to being tested again. That 4.34 on the 10-year, he's right. We are getting very close to testing that again. In fact, we're down off of the high for the last 24 hours, but we were at 4.325 within 24 hours. So 4.34, we're getting dangerously close to that, I would agree. Last time we broke this 4.34 level that he's talking about was last October. Obviously, we know what happened when we broke that last October. This is what happened. If we break above this level, bond traders can sell bonds, and they can take the 10-year yields much higher if the Fed doesn't step in. So what happened last time was they took it all the way to 5%. Okay, they took the 10-year yield when it broke 4.34 last year in October all the way to 5, and that's when we experienced 8% mortgage rates. So we don't want to go over 4.34 on the 10-year. In fact, we really want to stay under Logan's prediction, which is, we're 6 months in, his prediction of the 10-year bouncing between 4.25 and where was he on the 10-year on that? Actually, I've had a screenshot of it. 4.25 and 2.75, I believe it was on the 10-year, his prediction. We've already broken the 4.25. We're sitting above it now. So his prediction on the high side hasn't come in. He had a range, right? And So we want to stay under that 425 of his range. The Fed has said they don't want this to happen. Neither do we, because policy would be too restrictive. But short-term bond traders, they don't care. They care about the money. They care about the cash. It was good to see Fed Governor Waller try to push back on the recent move in yields last week, but they're playing with fire here, Logan says. It's not the best thing for the Fed to be playing with fire. We have bounced from 3.8% area twice. That was late 23 and early 24. This year have mostly stayed between 3.8 and 4.25. And it's not surprising because of the low jobless claims data. That starts to increase. You can start to see the 10-year come down. The 4.34 is not part of his 2024 forecast. Again, he has a range that goes up to 4.25, and we've broken that. But if this does happen, if we break the 4.34 like we did last year, momentarily, look for Fed members to try to talk the bond market down again, especially if this escalates to a 5% and 8% on the 30-year fixed. Here's your chart right here on the 10-year going back to March. You can see when it hit the 5 in October. That's when we had the 30-year fix come in at over 8. So we'll keep our eye on that here on the hot sheet, as we do each and every single day. Seeing that the 10-year is down a little bit here to start the day, we're hopeful that that'll bring the 30-year fixed down. Okay, you can get more information on the market tracker in the hot sheet show notes. In fact, we have 6 downloads just from that first segment on the market tracker available for you. Downloads being the charts, and all of this data here in the show notes, as well as another 3 charts and 7 charts in our last 2 segments, which is housing starts and Zillow housing report, as well as these show notes, which we give to our BAMX members each and every single day. And we have our biggest discount going for the month of February in honor of our presidents from yesterday's President's Day. You can use code POTUS, 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 to get 20% off of Hot Sheet. So use POTUS to get 20% off of the Hot Sheet when you sign up using code POTUS. All right, let's jump into housing starts. Housing starts are down slightly. Privately owned housing units authorized in building permits in January reached a seasonally adjusted rate of 1.47 million. That's a 1.5% decrease from the revised rate of December, 1.493 million. So housing starts are still incredibly strong. Builder sentiment has gone up 3 months in a row. Builders are feeling good about the spring market, and they're continuing to build. They're not building ahead of pace, and there's an argument here that the product that they're building doesn't even meet the shortage of supply that we need. Logan's number, we went over the number, million to 4.4 million was the updated number that Resi Club had reported, based on, I think it was 10 different sources. Logan's on the high side of that. If you listen to Knowledge Brokers Pod, he's up over 4.5 million on inventory shortage to meet demand across the country. Going back to housing starts, despite the month-to-month decline, small decline, 1.5%, the January 2024 rate stands at 8.6% above January 2023 of 1.354. So we're building more housing starts happening this year than last year. Builders are more comfortable with where the rate is. They're more comfortable with this market, particularly with where inventory is. Single-family authorizations in January were recorded at a rate of just about 1 million, making a 1.6% increase from the revised December figure of just under 1 million. Multifamily authorizations, 5 units or more, reached a rate of 405,000 in January, highlighting ongoing activity in multi-unit housing construction. This is one thing I'm like, are they building too much of this? Because we have the most inventory coming on this year in multifamily that we've ever seen. So we are building a significant amount of apartments right now, the most we've built at any time. And we're going to continue to see that inventory come on here this year and going into next year as well. Privately owned housing starts in January saw a notable decline. That was annual rate of 1.33 million, which is 14.8% below the revised December estimate of 1.562 million on privately owned housing starts. Okay. Um, so there you go on the housing start data. We'll have all the charts available for you. The next release, obviously, March 19th. This is the U.S. Census Bureau data. Permit starts and completions have been kind of, I would say, really for the last year, roughly flat when you really look at it. But here's the new housing starts in the U.S. 1.331, and then 1 million for single family. Total starts at 1.331, and single family at 1 million. So pretty steady, Eddie, pretty strong on housing starts. Home shopping, according to Zillow, early May, I'm sorry, payoff as price cuts are going to be more prevalent in the spring. Not sure if I completely agree with that. Buyers and sellers should prepare for a competitive home shopping season come spring. I agree with that. There's going to be some competition out there in the spring. Attractive, well-priced homes are being snapped up quickly. Agree with that. I'm sure all of you do as well. While many of those that have been lingering on the market are seeing their asking prices cut as sellers gauge market temperature. Well, we know it's 30%, according to Altos research. But Zillow is saying that they expect that number to go up into the spring. I think that's going to be market dependent. Okay. Got to know your market and see if that's where your market's going to sit in. Not sure that I necessarily agree with that. Increased frequency of price cuts seen as sellers adjust to market conditions. I think that's price dependent and market dependent. Home values, according to Zillow, typical price in the U.S. for January was $344,159. You may be thinking that, wow, I'd love to see that in my market, or you may be thinking that's above your market, depending on where you are. Home values are up from a year ago levels in 47 of the 57 largest metro areas. Okay, so for everybody that thought prices were going to go down in 2023, that continues to be debunked. 47 of the largest 50 metros, we saw prices go up. Highest annual price gains in January. Again, Hartford near the top of the list, Hartford Metro in Connecticut at 12.2%, where there is potentially the least amount of inventory in the entire country. San Diego up 9.6%, Providence up 8.3%, Boston up 8%, and LA up 7.4%. So you've got two major cities in California up big numbers, and then three Northeast metros all up big numbers. The Northeast, very easy to explain when you look at the inventory. Home values are down from a year ago in New Orleans, Austin, and San Antonio. New Orleans leading the pack at negative 8.2%. All right. January did see a 43.5% month over month increase in new listings. That's reflective of what we're looking at with that Altos data. And new listings is a great sign for a spring market. Kim says in the Carolinas that there are multiple offers happening in her market. I know both the Carolinas, North and South, are very attractive markets, very competitive. I was just talking to somebody from Charlotte yesterday, and Charlotte's blowing up in particular. I think there's a 15-year run there that's going to happen as they continue to grow. And also here, January inventory. Overall inventory, according to Zillow, increased 1.5% from the previous month, 3.2% more. And it should increase from the previous month. It should increase from December to January. You should always see inventory increase there. 3.2% more listings were active compared to last year. Inventory levels are still 37.3% lower than pre-pandemic levels. We looked at that, obviously, with the Altos data. I like to compare 2019 as a normal market. 2019, we were coming into 2020. 2020 was going to be a great market. It was a weird market, but it was going to be a very normal, stable, strong market, particularly strong for sellers. It ended up being obnoxiously strong for sellers towards the later half of that year. Inventory fell year over year in 30 of the 50 major markets, with the biggest inventory declines being Vegas, almost at 30%, Seattle at 22.3%, and DC at 21.1%. In January, listings sold in 29 days. That's slower than during low mortgage rate periods, but faster than pre-pandemic norm. So homes are still selling faster than a normal pre-pandemic market. 20.9% of listings had price cuts according to Zillow. This is where you see different data. Altos is up at 30%, 20.9% according to Zillow, slightly down from last year, but higher than prior years, where Altos and Logan say, hey, 30% is normal. Okay. So, you got to know what's normal for your market. Of course, 26.4% of homes sold above list price in December. And I can imagine we're going to see some of that here in February and going in further into the spring market. There's your Zillow update. There are 7 charts uh, available for Zillow data that you can grab as well. So ton of charts, ton of data for you inside of BAMX. Use code POTUS to get 20% off of that. We see a 10-year here that's sitting around 4.273. And we'll see if we can bounce down from the 7.14 on the 30-year fixed that we closed out the week last week on Friday. They did not have a mortgage read yesterday with President's Day, but we'll get one today. Hopefully we can start trending back towards 7 and break through and get back into that 6 handle range sooner than later. That's your hot sheet for today. Thank you so much for joining me. I will be back here live tomorrow, 9:30 on the East, 6:30 on the West. You know the deal, everywhere in between. Until then, toodaloo.